Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm also, as I like to remind you each and every week, the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying? Right now, before we go to our first commercial, I'm glad to have Michael Oliver with us at least for a few minutes. Thanks for joining me again, Michael.
Good to be here, Jay.
Always good to have you, and always good to tell our listeners that they should go to olivermsa.com, olivermsa.com, to learn more about Michael's excellent work, which I hold in very high reverence. You put out a missive this morning, Michael, with some very interesting momentum charts showing a sideways move for the S&P over the past 4 years that looks eerily similar to the momentum and structural chart that you showed for the S&P 500 from the years 2003, 2007. Can you comment on that and what it may mean for us right now as we begin to look into 2016?
Sure. The sideways, of course, is in the momentum readings. The price has gone up in the S&P, of course, for the last 4 or 5 years. But the action since 2012-13, we have taken out the 2014 momentum low this year, but we halted in the August sell-off when the S&P dropped down to the 1860s. It stopped at 12% over the current 3-year moving average. Okay, so what I'm doing when I measure momentum is I'm measuring price in relation to the mean. Okay, and what happened was the low in 2012 and the low in 2013 were also 12% over the current 3-year average at that time. So when you plot a momentum chart, you've got these 3 of the last 4 years have the same low. Okay, now that's called a structure. That's why my report is called Momentum Structural Analysis. When you break a floor like that, it's like a price chart breaking through a massive floor. You don't see it on the price chart of the S&P because it's uptrending. But on momentum, it's flat. If you touch 10% over next year, and that's 20 trading days away, 10% over the new 3-year average converts to a price of $20.90. And we're there. So if you diddle-daddle around between now and December, or you close barely above there or barely below there, you touch 2090 next year, and I'm going to blow out 4 years of momentum lows on this annual momentum chart, and I suspect strongly you will get a downside move of consequence. This is what happened at the close of 2007. We closed at 1468 price. That was fully 100 points above the low of the year. So it wasn't a threat to the price low of 2007, which occurred in August, coincidentally the same as our low. But it closed such that when you opened 2008, with the change in the 3-year average, the momentum structure went through the floor. And we're dancing around in almost precisely the same manner, where your topping year, which let's call 2015 the topping year, was like 2007. And if you recall, 2007 was a real monkey cage. I mean, it was up, down, up, down, up, down, and just twisted all around, really sort of trendless after the spring. And then finally, when it opened 2008, it just said, okay, that's it. And the party started. So we're positioned in much the same way. Right?
Yeah, you mentioned, Michael, that if you have an up market for a number of years, as we've had with the S&P 500, with the equity markets, and then you start this sideways momentum basing pattern, that normally it's like a coil that's springed up, and normally the resolution is in the opposite direction of whence it's come. So we're looking at that so the prediction on your part and on the part of many people that I follow, I suppose, is that we're going to have some very difficult days in the equity markets. But if that's true for equities, what about gold, which has had the opposite sort of momentum?
It's most of the gold bear occurred in 2013. People need to remember that. We dropped to 1178, and we had been over 1900 in 2011. By the summer of 2013, you were 1178. That was the real crash in gold. Over the subsequent 2 years now, gold has shed another $100 or so.
Yeah.
Put that in perspective. It took 2 years to shed less than 10%. So really the decline in gold that people should have been screaming about was the collapse in 2013. Everything since then has been residue. This year's range in gold, I think, is about 20% from high to low. And we've been well up on the year, of course, at some point during the year. And then, of course, the recent lows at 1051. But the range, the volatility of the year is much like the S&P. It has contracted sharply compared to the prior 3 or 4 years. We're also seeing this in oil. Oil had a huge down year last year, and if you look just at this year, from January to the present, it's actually a fairly narrow range compared to last year. Well, so we're seeing this after markets have had large moves in one direction, and then suddenly things dry up. That in itself is a sign of a balance change, especially if there's age and maturity in the trend, the prior trend. In the case of gold, there is age and maturity. It peaked in 2011. We're now 2015. That's a lot of maturity on the downside. Stock, same story. Now, when you get congestion, like we're getting in the S&P, but if it were only after, let's say, a year or so of upside, that might just be congestion prior to another leg up. But once you've spent 4 or 5 years, the odds are no. It's likely a top.
Very interesting. Well, we'll certainly keep a watch of it, that's for sure. And the idea that oil could actually, I think you actually put a missive out this week that suggested we could actually see some fair amount of strength in oil this in 2016.
I've got some trigger numbers that need to be elected and gone through. Starting at 43, next one's 45, and the last one's just above 49. But if we do, you're going into the mid-60s next year. Now, mid-60s is nothing historically for oil. I mean, it's still cheap. You go back and look historically. But that would be a sizable percent move. And I call that really, I would call that, while it's a major move in percent terms from the recent low at 37.75, it's really just a big bear market rally. I think you will have seen your low in oil at that point if you ever go to the mid-60s, but you're not going to trend through there. I don't know, you're not going back to 90 or 100 or anything like that anytime in the foreseeable future. But the first move off the mat could be more sizable than most people can currently conceive of in oil, especially when they were swimming in oil. There's only one way it can go, and that's always down. Well,
well, it would seem so. That's the way you always feel when you've been in a sustained move in one direction or another. It's going to always be that way, and of course we know that isn't true from history if we just look back a little bit. Well, certainly $40 to $60, let's say from the current 40 level to 60, would certainly do wonders for some of the lagging oil stocks that I follow. So, I mean, that would be something to look forward to. We'll certainly be watching your work very carefully, Michael, for that. And we unfortunately are out of time. Always great to have you. Thank you so much again for joining us. And again, folks, it's olivermsa.com, olivermsa.com.